Hey, all right. Friday. Morning, everybody. So we made it to the end of the week, first week in the new month. We've been in the hurry up and wait mode all week. And while I kind of really thought it was going to be ADP on Wednesday, it wasn't. We have data coming out today that is delayed, but still highly anticipated. And we have broke the iX-10, so we're on the move. We'll see what plays out with it from here. A lot of Fridays we look for a sideways day because, who who wants to add to risk in front of a weekend? But when we've been sideways all week like this, I would not anticipate another sideways day. So if we get one, fine, we get one. It's easy enough to know that we're sideways, right? You just look to the left if we're inside the Globex. If we're inside yesterday's range, then ta-da, we're sideways. It's not a surprise. The trick will be if we attempt the breakout on either edge and get through the 1, 2, 3, 6, and then begin to expand. Japan is up a 0.5% this morning, outrunning everything we've got. Um, that really seems more defensive than anything else. I'm not feeling it bullish. NASDAQ coming in just above 0.25%, leading the way. So at least the indexes are behaving more normal again. And small caps are underwater, but really just barely, holding the line. So these are delayed reports. I think it's still going to be a while before we get things back on track. And if they don't come to some sort of agreement soon, we're going to be right back in the situation where the government shuts down again. I'm not pointing any fingers. Both sides are broken and corrupt, but the rest of us are the ones that suffer. So maybe someday they'll fix it. 8:30 is the big one, but at 10 o'clock, we are going to get the consumer sentiment. These sentiment gauges never really have been that exciting for me, but the market is looking for any excuse. And when we're in that sort of situation, any excuse will do. So just because it is a sentiment report, right? It's that warm, fuzzy feeling. How do you feel today? I don't feel good. That's the sort of wishy-washy, touchy-feely, salty report we're going to be getting our hands on. And yeah, maybe it's sunshine and rainbows and butterflies, and maybe not. We'll find out at 10 o'clock. Generally, I would not look for those to move markets. But if we get through 8:30 and we're still sideways inside of Globex and we're not getting anything done, look ahead to the next report, and that would be sentiment at 10 a.m. The consumer credit is going to go towards the quants. That's 3 o'clock. There's a lot of talk about the the lack of engagement through Black Friday, Cyber Monday this year, and these buy now, pay later places that are being used for people to get their groceries, no less, right? Completely unsustainable. But let's see what credit looks like this afternoon. It shouldn't be an impact on the intraday itself, just sort of the bigger picture, broader outlook of how is things out there. And that'll get us into the weekend. Well, thank goodness we go to more than one site. 11 o'clock today. Consumer inflation expectations. That'll do. That one right there. We are going to get a little bit out of Europe lane again, chipping teeth just after 11 o'clock. This is likely going to be one of those days where the hits just keep coming and we're going to get headlines all day long. Even this afternoon, there's the capacity for a data dump and a gotcha move, right? Where there's somebody like the White House just dumps a bunch of, oh, by the way, news. We'll see how that plans out. But the whole morning, keep your eye on the clock. It looks like we're just going to keep having it trickle in all morning long. There is the opportunity for the president to chip his teeth during these executive orders. It doesn't say he's going to talk, but all it takes is someone to start asking questions and then he could start talking and that can move markets. So the World Cup draw, I'm not really expecting much from that. But later in the day, we could see something. So watch the clock around 2. I'm continuing to hear these little side remarks about how the Fed might not cut. They've already telegraphed the cut. If they don't do it now, it's going to freak the market out. Not because just on its own that the market is pricing in the cut, but because markets really don't like surprises, and the Fed knows that. They go out of their way as much as they can to telegraph what they're going to do because they know the market doesn't like surprises, right? Telegraphing and communicating is uh, a blight on the Fed. Seriously, they just really do a horrible job at it. But I really don't see a path where they say, "Nah, we're not going to cut. We're going to sit tight." And sure, they absolutely can do that. But are they likely to do that? I don't think so. So if you continue to hear all this talk about maybe they won't cut, maybe they're just going to hold, it's absolutely possible, but is it likely? And that's what I would ask anybody you hear saying that. Sure, it's possible. Of course, it's possible. But is it likely? The odds on that. Even what's the poly market odds on that? All right, Mentor Q CTA positioning can see they are still trying to increase their holdings, but they're doing it in a more sedate way rather than this riptide that they were focused on before. It's interesting how on this site, which is Gamma Labs, we can see CTA positioning, but we can also see CTA positioning change, which I like to do because this is just going to show us the granularity of those changes. If it pops back up again, I probably need to refresh. I was looking at all of these earlier. It's going to get shy now. But the changes stand out, right? So there's a lot of places that have these tools. You kind of fiddle around with them. I don't know why it's not working now. Probably because it's shy. But there's also the vol control funds and their projections and their changes. And the CTA positioning projected, Goldman puts out a report. I don't know how often they do it because I don't get the report personally, but they do put out a report that talks about CTA positioning and what the CTA is likely to do if the S&P moves up X amount or down X amount in a percentage basis. It's a really good report if you get your hands on it. I don't get the report unless somebody shares it with me, so it's kind of hit and miss when I get to see it. But that can really give you some insight on, hey, if the S&P does go down 3%, 5%, what's the projected CTA activity going to look like? How much are they going to get out of? Now, the VC funds, they run based on what volatility is doing. So above a certain level in volatility, they will exit X amount of their positions, and below a certain level in volatility, they will increase their position. Completely non-discretionary trading, right? They don't look at the stock price, they don't look at indicators or anything else, just what is the volatility, and the volatility dictates whether they're increasing or decreasing their portfolios. SPX gamma flip level 7665. Seems a long way off, doesn't it? I heard a lot of talk about how retail investors aggressively bought around that Thanksgiving Black Friday. And what it feels like is sold to you, right? Retail was buying like crazy. Who were they buying it from? Yeah, you get the idea. The gamma neutral level keeps inching higher and higher, suggesting that options positioning is getting more and more bullish. That's from Gamma Labs report, right? If I was to click this, that's what we were just looking at, the Gamma briefing. Sold to you, baby. You like it. We are a long ways from the volatility trigger and the zero gamma. We are above all of the moving averages, as we can see here on the daily. They're just plotted on the intraday. We still have not breached this lower high yet. And this level here, since it was a one-day wonder on the pullback, doesn't even count as our next lower high. But I guess it would depend on the analyst too, right? For me, it doesn't count, especially if I was to put this in a line chart. You wouldn't see a pivot there. So we got to resolve this high. It's the answer to what we have in this topping pattern. It's been a beautiful run up and a nice digestion, like we were talking about. Everything has been behaving nicely. And when it comes to technical analysis, a lot of what we're doing is just looking at what happened in the past and making assumptions about what will happen in the future, right? That's really kind of it in a nutshell. Patterns, repeating behaviors, that helps, but as long as the market is behaving in a normal way, then technical analysis works relatively well. It's when we start misbehaving, big violent moves in either direction, gaps up and down, violent wick behavior. Once it starts misbehaving, it separates itself from the typical analysis that we can do. And the less likely that the analysis we can do becomes accurate, because, technical analysis is based on past performance of normalized price action. This has behaving in a normalized way. It's great. It's doing exactly what it's supposed to be doing. and it hasn't stepped out of line yet. We've been iX-10 all week, which is unusual for the S&P to remain that long inside that range. Now, when it's a really big range, right? Say if we were stuck inside the November 13 bar for a week and a half, that would be one thing because it's a really big bar. This is, relatively speaking, a small bar, 60 points ish. So we finally got out of it. We're on the run. That compression is fuel. So now we just need to see where we're going to go. If we're running OCR analysis, by the way, rather than the typical plain Jane everyday kind of analysis, then after this lower high, which had a higher low, by the way, and a higher close, it's been higher high and higher lows. And we only need 2 for a full set. So 2 higher highs, 2 higher lows, that is trend. It's been above the 3-period moving average with little retraces to kind of fuel up. OCR at its best. So we do have this level of resistance, the big round number 969.11, cog line above that, and then 6950 above all of that. So there's a 32 in there if you're really interested in it. And there's a 92 from the cog line. So you can start laying them out. There are easily identifiable price targets all the way up from here, right? That's the cog, then the roundy. $68.88 is the options level from a spot gamma, and 69.08 and 69.10, those are also from spot gamma. It's those red lines that you see on my chart. Other than that, we have these levels laid out, and of course we got a quarter level. 69.25 is in there. So it is level by level. If we get through one, we continue to look ahead to the next one. And I know a lot of newer traders, they just want to be told, where's it going? Is it going to 32? Is it going to 50? It's going level by level. So if you get through one, you're going to the next one. If you get through that one, you're going to the next one. That's just the way it works. And we keep looking for anything that says that it's slowing down, losing its momentum, running into a wall of sellers, anything that can shut this move down. And if we don't have it and it continues to push, then we continue to aim for the next line and level. You can see the put wall 6,500. You know, we can reach that today, by the way. I don't have any expectation that we're going to do that, but just saying 6,500 is easily attainable in a single day. So the put wall is still within reach. I mentioned this because somebody the other day had made a comment to me that since we had outrun the put wall, no, we didn't. It's not too far away by any stretch of the imagination. The S&P has, the market has lock limits, not just the S&P. If the futures fall 7%, they're going to lock into place. And after 15 minutes, they'll open the markets. And if they drop another X amount of percent, they'll lock again. Third time's a charm, they'll shut it down for the day. So, you know, asking the question, is the put wall at least 7% away from our current location? If it's not, we won't even trigger a lock limit getting there. And it's not even 6%. We can go there in a single day. It would be a very violent move, but we could do it. Not expecting that, by the way. Hey, looky there. We've been waiting for it all week. Whatever the hurry up and wait was, at least we were able to identify it. I'll stick to that, even if we couldn't figure out which one of them this week it was going to be. And every day that we didn't see this continued to prove that it wasn't the day. But there it is. They are hedging this morning. They are concerned, as if we didn't already know that from the price action, right? Look how tightly wound this is. Come on, man, that ain't right. This is very unnatural, and it's very dangerous. It also, if we go back to my other chart for a moment, was showing up in the volume activity, right? You see the liquidity risk tag down there. Why? Because we're not even running 50K in the overnight session. Where is everybody? Maybe the holidays, right? Maybe they're closed, which you can always check, like I've mentioned. If you come up with a lack of volume in the overnight, start asking questions. Was somebody closed? Did Europe not open? Was Asia closed for a holiday? You can check that. It's free. Doesn't cost you anything. Even Thinkorswim has a generic market open from other nations, but it's generic. It doesn't check for holidays and that sort of stuff. So really tightly wound in the overnight. They took our hurry up and wait mode into a whole new level, and we are on wait. They are sitting out of the price action, and they are hedging. We know that they are hedging. I'm not giving you my opinion. I'm not guessing. I'm stating a fact. They are adding additional hedges. Now, if you and I wanted to add a hedge, we can turn that into a trade. You know, it's just another day at the office. We can trade it. For them, a hedge is just cost. It's literally lighting a fire and throwing money into it just to watch it burn. That's what they're doing. They can't get their money back. Why would they spend that kind of money? Because they're worried about something. And how do we know that? Because there's a market maker move today. Market maker moves are triggered when they trade in the front end with increasing size and pace of the trade, that it changes the implied volatility average. When that implied volatility average gets higher than the next average out, it triggers the market maker move. If you Google market maker move Thinkorswim, you will find articles by Schwab that explains this. They just won't talk about futures in that article. So we know they're hedging. This is the thing that we've been waiting for all week. It's why the market's been sideways all week. It validates the hurry up and wait mode we've been sitting in all week. And it's very likely that now we're going to go. But here's a little bit of a rub on all of that. And I'm sure you guys have seen it before. When you have a big event looming in the horizon and everybody starts to get excited about it, we'll just say it's CPI. So everybody's waiting on CPI. They keep hyping it up. They're talking about it more and more. Oh, yeah, CPI, it's going to be so big. We're going to make some great moves. Well, you know what happens? They hedge the holy living hell out of it to where if it goes down, they don't get hurt. If it goes up, they don't get hurt. And if they don't get out because they're not getting hurt, then what's going to happen? It's not going to make big moves. Markets make big moves when people get caught on the wrong side and they're all scrambling to get caught up. If you're hedged to the eyeballs and you don't need to get out, the big move never materializes. So they're hedging like crazy because they see a big threat to the market based on news we're going to get today. How likely is it that that news today causes a big move? Not as big of a likelihood as we would anticipate because they are hedged to the hilt. They don't need to respond. They won't be off sides because they won't matter if it goes up or down. The main takeaway from seeing the market maker move this morning is that the hurry up and wait is likely done today. And that next week we can start focusing on something else instead. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. We tagged it and stayed above it, and that's also bullish. We got an inside day breakout, but we was not able to keep it, and that is not so bullish. We are still holding the highs, though, so we can attempt another inside day breakout and do it again. But the fact that we already did it once and gave it away, not as bullish. I didn't trade it last night because I no longer trade in the evenings. But there's the 111 of yesterday. I love that trade. It's such a wonderful trade. So if we've already reversed yesterday's 111, we might not get another shot at it today, good news or otherwise. I really like that trade. We rejected R1. There is a concept that says R1, S2. You know where S2 is, right? S2 is way down here. 6811 cog line. Well, 6816. But you get the idea. It's all the way down here at yonder. Just because we went to R1 and rejected does not mean we have to go to S2, but that is the phrase, right? R1, S2, S1, R2. At the bare minimum, rejecting R1 offers floor pivot at 6860. If you get underneath the floor pivot, then you have S1, 6842 old school cog line. Then yesterday's RTH low, 6832 cog line, the weekly channel top, and then 6816 S2, level by level by level. Just run it on down. All we got to do to get there, by the way, is break this range that we've been developing here. GTFO, the box gets bigger as we go. If we happen to get back above R1, or even just get to R1, we would have to get above it, A, and then we can go to R2, right? So if we can get back to 68.85 and close above that level, 69.05 is on the table. Because that's the way it works, right? Level by level by level. We still have a really nice distribution on the week so far, but this little breakout this morning is interrupting that nice distribution. The takeaway of this is that if we do reject and start to fade back down, we've got a lot of structure back here that could very likely stop us from a major crash and burn. We have last week's structure and this week's all in this area. So yeah, I mean, we could reject today and fade back, but we're not looking for like a air gap and a flash crash sort of scenario until we could get below, say, 6830, where it begins to thin out. That could possibly get us into some sort of air pocket of risk, but we're nowhere near that level, and we would have to get through all this structure that's underneath, including all of those moving averages too. Ten-day, 30-minute volume profile and TPO. The volume profile still looks really ugly. I mean, it's just a disgusting, nasty looking chart. And it does have these speed bumps. At least that one matches with the TPO. You guys remember in that Rambo 1 when he dove off the cliff and hit every tree branch on the way down? Yeah, that'd be kind of what this would look like on our way down, right? Just branch after branch after branch, breaking our nuggets along the way. I don't think it'd be a straight shot to the downside. Even though we were iX-10 this week, you can still see what Linreg was pointing to all week. So as long as we're in this zone, the point of control will act more like gravity or a magnet and less like support or resistance, which is why we can cut back and forth above it and below it. If we were to get too far away, quote, quote, too far, and then we try to come back into it, it then would very likely act as a support or resistance. And you can see that how far we're getting away from it continues to increase a little farther, a little farther, a little farther. Those sort of increases or distances from the point of control just continue to stretch the range of how far we can get away from it. For that to start acting as a support or resistance, we would need to take the original range and double it in a short period of time, higher or lower. Then, if we was to come back at it, it would act supportive or resistant. So all the way up the top of that, or all the way down at the bottom of that. And you could cut that level in half. The main thing would be that we have to leave the red line swiftly in a single shot, get far enough away, and then try to come back at that red line for it to begin to act supportive or resistive. If or until that was to happen, then we can just continue to cross around back and forth and just see it act like a magnet. A little bit of work yesterday on that pop up right before the open. Nothing down here along these lows. We didn't run into a bunch of buyers. Sellers just got exhausted yesterday, and we buoyed back up afterwards. Looking at what we're getting today so far, lots of structure across this area on low volume, no less. We're not hitting a wall of sellers up here. Buyers just don't have any impetus to continue to push beyond that. And when we did start out last night in the Globex, we were getting a little work here before we expanded. But we got nothing, right? There's nothing here. It's pretty ugly. Keep track of yesterday's VPOC. Well, it's not a VPOC now. It's just a POC. Keep track of yesterday's point of control. It may provide some insight if we were to drop that low today. It's basically 65. So it's 68, 65-ish. Really, if we get that low, we're probably going to just go ahead and check our own Globex low, but whatever. Keep that point of control in mind. It's not a VPOC because we've already hit that area. And like we do every Friday, we get an opportunity to see next week's range. Is it not Friday? Sure it is. I just have to put the chart back on. I had it on the SPX for a previous conversation somewhere else. All right, we always get a chance on Friday to see next week's range early. Just keep in mind that that range is not set in stone yet. It's going to continue to move with us all day today. The gray line is where our price is right now, and the red and yellow, the red and green lines will contract and expand all day based on volatility. After the close today, when the markets settle and they finally stop moving, it'll lock into place, and that'll be that. We were in hurry up and wait mode this week because the size of this range told us that the market had priced in a sideways week. Of course, it didn't have to do that, right? It could have broke out and said, screw you, market, and just done whatever it wanted, because price can do whatever it wants, right? But the size of it warned us that it was likely to be a hurry up and wait week. And that's what we got, right? I mean, the whole darn week, it was supposed to end Wednesday, and it didn't. We've been sitting here the full 5 days. But that narrow range was a huge heads up that the market was not anticipating expansion this week. Take a look at next week's range. Now, it's just a forecast because that's not done moving yet. But so far, next week's range is narrower than this week's range. Days matter. The math formula for this range is how much time do you have and what is the volatility. So if we have a short week, we have less days. The analogy to that is how far can you drive if you were to drive for 5 hours versus how far could you drive if you only drive for 3.5 or 4 hours. Obviously, if you drive for 5 hours, you can go farther. Same thing here. How far can price move if we only have a 3-day week or a 4-day week versus how far can price move if we have a 5-day week. So that's the time part. The other part is volatility. At first blush, low volatility makes us think, oh, they must not be worried about anything next week. It's got a really low vol, a narrow range. Unfortunately, big events are volatility suppressing events. CPI, PPI, non-farm payrolls, FOMC, those are all volatility suppressing events. I know, I get it. The first time I heard somebody say FOMC was volatility suppressing, I thought, what are you, cracked? Somebody drop you as a child? FOMC is not volatility suppressing. Have you seen price move in FOMC? But they're not talking about how price moves when we get to FOMC. They're talking about how price moves as we get towards FOMC, CPI, non-farm payrolls, any of those, right? So markets will anticipate sideways behavior in front of those sort of events. Next week is projected to be a narrow range week, just like this week was. So we are going to be on watch again next week, looking for the what are we waiting for event. I'll just highlight it while we're here. That week right there. Narrow range for 3 days, 4 days. On day 5, oh boy, we moved. Now that happened to have gone down, but it didn't have to go down. The situation is the same. The outcome can be different. The main thing is we can make big moves, right? We've been sideways all week. It's been a very narrow range for this sideways range. And it is now possible that we expand significantly. It's projecting an upside move. I mean, if you look at what we've got right now, we're testing the high of this entire range, and Linreg had been pointing higher through the whole thing. I showed that already. We had a 3.9% move the last time it was this narrow for that many days. Almost a 4% move. And if we counted it from the previous day's high to the next day's low, it was a 4% move. Good enough for me. So we can do the same thing the other way around. If we're looking higher, look at the previous day's low and move 4%. That gets us to 7,100. Or the previous day's high and we look 4%, 6,600. Oh, well, that's not bad, right? 71 and 66. I'm not saying that we're going to go there today. The fact that next week's range is as narrow or even narrower than this week's range kind of implies that the hurry up and wait isn't done yet and that we might not make a move today at all. We could wick outside of the range and come right back in today and still be in hurry up and wait next week. Yeah, it sucks, doesn't it? But if you look at the broader equity market, the rest of the market isn't in hurry up and wait mode. It's just the indices. What's up with that, y'all? Either way, we have the projection for next week's range. On Monday, we will look at it again and see how much it changed versus what we talked about this morning. And looking at how far we are above the 10-week, we're not overbought, we're not overextended. We have moved a bit to the upside. We're at 2%. That kind of limits us for today. If we did get a 4% move today, that would put us around 6% above the 10-week. And that is a bit much. I think the market would mean revert off of that, right? Because if you look back at us being above the 10-week at 6%, it never stays there. It gets there and immediately retraces. So if we did go that high today, it would automatically be a reversal next week, even for just some sort of pullback. But the funny thing about this indicator is it's the distance from 10. So we could get there and just freeze into place and the 10 would come to us anyways. We wouldn't have to retrace back to the 10. The 10 is going to follow us like a lost puppy. It's coming after us. But we would begin to look for a correction after that big of a move. And our distance from the 10-day is not even 1%. And you can see how we've been just maintaining our distance nicely all week. If we were to move 4% today, that would put us at 4.8-ish. And I don't even have a 4-point mark on the screen for how far away from the 10 we can get. I'm sure if I look back, I can find one somewhere. But we don't want to see price run 4% away from the 10-day in a single shot. So while it's possible that we can make that sort of a move, what's more likely is that we move, say, for an example, to the downside. If we're already up 1% and then we fall 3%, we end up at -2 because we gave one back. That gets us to 0. And then we move 2 more points to the downside, and that gets us to a -2. Well, that lines up really well with our previous distances from the moving average. But I'm not bearish. So while that math suits, it doesn't fit my bias. If today is going to be a blowout day, it's going to need some sort of fuel. The easy stuff would be Mag 7, chips, consumer discretionary, communications, those sort of companies driving us higher or lower. Behind that, having gold with us, Bitcoin, that would really be helpful. If we don't have that sort of a backdrop, the only other thing that could really get it done would be 0-day options flow, but we can't see that in the pre-market. We can see the things that are down, Bitcoin. Well, if Bitcoin's down, then it's not up, helping us for a breakout day. So we could see that turn around and it could, get into the fight for the upside. Otherwise, having that down kind of implies that we're not going to get any help from Bitcoin. Looking at what's up, China, emerging markets, that's also China, gold miners, more China, uranium, chips. Nice to have chips on our side again. Quantum, that's not really helpful. Tech, growth, generically speaking. So we've got the sectors that we need. We don't need Bitcoin, but we don't want to fight Bitcoin. So either Bitcoin needs to stop falling and just go sideways, kind of, like get the hell out of the way, or it needs to hop on board and help us out. If it remains divergent between what we have that could help us and what could hurt us, and they don't all start to align, then it's very likely that we stay in this sideways state and go into hurry up and wait mode for next week too. But I will remind, they are hedging this morning. The hedge isn't all that big yet. So either they're not in a rush and it's going to get widened out as we wait, or they didn't think they needed to have a very big hedge, and so they just didn't make it very big. 0.31, and that's not very big. If this gets above 0.5, starts getting into 0.75, maybe even 1.0, now you're talking hedge size. But this is still indicating that they are hedging. It's just not massive yet. We got to get above R1 if we're going to continue to go any higher. Otherwise, we are done, and R1 leads to S2. So what I got for you guys, be careful, be safe, keep your eye on the clock. Look for this headline that's coming because they're scared about something.